Low interest rates signaling real trouble in the real economy, along with troubling disinflation, are being vindicated in every way. From a growing list of macroeconomic accounts to a recent bout of financial volatility, and even central bankers who are now abruptly pivoting. But some economists claim this is actually some form of stealth QE, and one that they also say is engineered by well-known monetary supergenius Janet Yellen. This is what happens when economists try to talk money and interest rates. They get everything, and I mean everything, totally backward. The bond rally from last year isn't the market becoming more pessimistic on global and U.S. prospects, therefore pricing lower growth and inflation. These economists say it's the government manipulating the market to boost the economy ahead of the coming election. In reality, economists who've been talking nonstop about nonstop inflation aren't willing to accept that market prices are exactly what they appear to be. Again, as evidence continues to more strongly and strenuously validate. To some people, low interest rates can't be real because they refuse to let go of inflation. First, it was that the Fed held interest rates down with QE and that yields would skyrocket once the Fed stopped buying bonds, only to find out interest rates didn't skyrocket, even as the Fed shifted to massive QT, all the while conducting epic rate hikes alongside. Now they claim interest rates would be a lot higher without the federal government manipulating the debt supply. And this is utter nonsense. Issuance has zero effect on yields. We would like it to, but the market has bigger worries. And those worries are named safety and liquidity. Make a world that's actually safe and well supplied with liquidity, not fake with QEs, then we can start talking about bond vigilantism. But the issue always comes down to misunderstanding what inflation is, misunderstanding what the price behavior the last couple years has been, and therefore making the bond market seem to be what it actually isn't. That's what we keep coming back to. It's the same thing that economists were talking about throughout the 2010s. Bond rates weren't low because they were signaling low growth and inflation that actually happened that way. No, bond rates were low because the Fed buys bonds, therefore it spoils the signal and we should ignore what rates are telling us. Now this narrative has been reborn as something that Janet Yellen is wielding as a stealth form of QE. She's manipulating Treasury issuance to make sure that longer-term yields stay low so that Democrats win in November. This theory has been put forward by a couple of Harvard-trained PhDs, so you know that they have no clue about money or interest rates and everything's going to be backwards from there. One of them by the name of Stephen Miran, who's a senior strategist at Hudson, and the other researcher is Nouriel Roubini, called Dr. Doom. And they recently wrote a paper, some articles, made a big splash over what they call activist treasury issuance. What is ATI? Well, here's what they say about it. By adjusting the maturity profile of its debt issuance, Treasury is dynamically managing financial conditions and through them, the economy, usurping core functions of the Federal Reserve. We dubbed this novel tool activist treasury issuance, or ATI. By manipulating the amount of interest rate risk owned by investors, it sounds really official and very academic, ATI works through the same channels as the Fed's quantitative easing program. So you already know they're way off the rails because they think it works in the same way that QE does, when we all know that QE doesn't do anything. So the biggest problem here is that economists like these, as well as those at the Fed, believe that they manipulate interest rates in order to use them to manipulate the economy, rather than looking at interest rates as a reflection of conditions in the economy. They instead look at interest rates as nothing more than some manipulated tool by some agency or government institution somewhere. So back to Roubini and Miran. We calculate that ATI has reduced 10-year yields over the last year by roughly 0.25%. Oh my God, that's huge. Providing similar stimulus as 1 point cut in the Fed funds rate, which means absolutely nothing, as I keep pointing out. But to economists, this is everything. You plug a number in a spreadsheet or a DSG model, and it means big things. In reality, it means absolutely nothing. The central bank's primary policy tool, that's what Fed funds rate cuts are. Combined with higher neutral rates, which again, economists can't really calculate, ATI implies a total stance of both monetary and issuance policy considered together is roughly neutral. In other words, ATI has interdicted the Fed's attempt to restrain the economy. Here's the important point: helping explain inflation persistence and upward nominal growth surprises, over the past year. Again, they think interest rates manipulate the economy rather than interest rates being a reflection of it. And so if the federal government is manipulating the Treasury issuance calendar in order to keep longer-term rates down, that's supposedly additional stimulus. And that quarter point less reduction in 10-year Treasury note yields supposedly explains sticky CPIs and a no-landing scenario. So they finish up saying, by contrary to the Fed's insistence that monetary conditions are quite restrictive, they are not. And Treasury's issuance policies help explain the persistence of inflation and strong economic growth, which not all that long ago, a couple of months ago, seemed absolutely plausible and positive. Yet, now that we see more and more that the warnings were just dismissed under the sticky CPI nonsense, we see more and more that the economy was not strong, it was actually weak, and that disinflation was simply temporarily detoured by gasoline and insurance costs earlier in the year. Those very same gasoline insurance costs that don't lead to more inflation, that actually lead to the disinflation and economic weakness that even central bankers now admit is actually happening. So what's the evidence for this ATI stuff? Well, first of all, it's the issuance calendar. The Treasury Department has been selling a ton of Treasury bills, and therefore, just from the very, very surface perspective on the face of things, it looks like the Treasury Department is choosing to sell far more bills, so it must be manipulating the issuance calendar in order to not sell too many notes that would leave interest rates going higher. But why does anybody believe that interest rates would be higher with an increased issuance in notes and bonds? Well, it has to go back to, a lot of it goes back to coincident timing last year. Last August, everyone freaked out when the Treasury Department announced its issuance calendar in the face of massive government deficits. Remember last year, huge government deficits, unexpected deficits, just absolutely enormous. And when the calendar initially came out that showed a terming out of the debt into more notes and bonds were selling off at the time. Interest rates were rising. Remember, we heard nonstop about how these auctions were going to be horrific. The government was going to sell way too many treasuries. The market would never be able to absorb it. And it looked at the time, especially August into September, as if the market was indeed rejecting this issuance calendar, that there was going to be too many treasuries and it would never be able to take it. But as we know, the bond rally began in the middle of October and things started to go in the opposite direction, which these people who support the ATI theory say was because the government came out at the end of October and early November and shifted the issuance calendar, taking some more notes and bonds off of their plans and going back more toward heavy reliance on Treasury bills. They manipulated the calendar and then the market magically rallied from there. Except that wasn't actually the case. Bonds weren't selling off last year because of Treasury's debt, its issuance plans, or anything related to it. They were selling off last year primarily because of coming off of the lows after the bank crisis earlier in the year, as well as the September effect. The September effect, especially August, September, and October. And as soon as we got to October, bond yields turned around. And it had nothing to do with the Treasury issuance changes or anything to do with Treasury issuance at all. But yet the media, the mainstream, everybody continued to focus on Treasury auctions because for a while it sounded like this was plausible. Plus, the mainstream idea, the mainstream narrative about how interest rates work are all about supply and the Fed or somebody else buying. It's never about the fundamental values that interest rates represent. They get it all backwards. So while rates were going up last year, it seemed like, okay, the government was issuing too many notes and bonds. And then as soon as the government said, we're not going to issue as many notes and bonds as we thought, that's where the rally came from. And that's just simply not the case. And we can see this in a number of ways. First of all, the government has sold a lot more notes and bonds, maybe not as much as they were planning last August, but that's simply because the deficit didn't come in as high as people had been fearing. But more than that, it's not just the United States Treasury market that experienced a bond rally last year. Interest rates going down, lower growth and inflation expectations around the world. I mean, just consider the fact that Treasury rates follow very closely their German counterparts. Because the United States government and the German government could not be more different when it comes to creditworthiness and their deficits and issuance and everything else. Yet, U.S. Treasury yields and German bond yields track very, very closely together. They have tracked very closely over the last year, really since last August and September when everything got going. In fact, the German market had turned around in early October, several weeks before the Treasury market would. It's not about issuance. It's not about the U.S. government one way or the other. It's not about the Germans and their fiscal prudence. It's about the fundamental characteristics of interest rates. Governments don't manipulate interest rates. Interest rates are much bigger than governments, and they're a reflection of safety, liquidity, growth, and inflation. Remember how this has gone over the last several years. They're really going back to the last decade, but just in the last several years, they said the Fed was buying so many bonds. That's the only reason why interest rates stayed low in 2021 and into 2022 until the Fed started hiking rates and then pushing rates up. But then the Fed stopped buying bonds in 2021 and began doing QT in 2022, and rates only went up part way given the Federal Reserve's rate hikes at the front. So the interest rates were supposed to skyrocket. They didn't. And then it was going to be inflation as far as the eye could see. In fact, Roubini was a huge proponent of perpetual new normal type of inflation when the bond market said that wasn't happening either, inverted yield curve. And then it was debt issuance, as we just talked about. One excuse after another, why interest rates were going to soar, and they never did, which actually should scare the pants out of you for other reasons. Not the inflationary reasons, but rather safety and liquidity. What level of high demand is there for safety and liquidity where interest rates can go even lower despite the issuance, despite the Federal Reserve's rate hikes, despite QT and everything else that has been said about the bond market? Despite all of it, rates are moving down. Safety and liquidity, growth and inflation expectations. Now, as far as the Treasury issuance goes, they're simply responding to market conditions. There is no single way in which the Treasury is supposed to be issuing debt, given the historic levels of deficits that they continue to run. In fact, Treasury is doing exactly what it has done in recent history when faced with enormous deficits, such as 2020, or go back to 2009. When faced with huge deficits, they always issue bills first. But Roubini said, no. Anything above 18% of the debt being issued in Treasury bills is classified as activist. And why does anybody take his word for it? Why does he get to draw a line in the sand? As I just said, in 2020, we got way more than that in Treasury bills. That wasn't activist Treasury issuance. That was simply you issue bills when faced with the huge deficits that came up in 2020. Bill issuance got to be up to 25% of the debt. Same thing in 2009. There was no nonsense about activist Treasury issuance back in 2009. It was simply that with the ARRA being passed and then put into effect, it meant that there was huge deficits that the government hadn't been funding before, along with the TARP deficits from the year before. Treasury began issuing tons of bills because that's what the market wanted. Now, if they would understand why the market wants bills, they'd be a step forward. But it's not that the government is activist. It's not that the government is intentionally skewing the issuance schedule. It's simply that this is what happens during these periods where debts just explode higher. They always issue more bills. And in this case, the market wants the bills, so why not give the market what it wants? As far as Roubini and Miran, as far as I can tell, they've bought into the inflation narrative. In fact, Roubini back in October and in November of 2022, he went on CNN October of 2022 and said that we are not going back to 2% inflation. And he actually said that 5% is going to be the new normal for consumer prices. Here's what Roubini said.
I don't expect hyperinflation. I don't even expect double-digit inflation. But I think that it's mission impossible to go back to 2%. The new normal is going to be something above 5%, below 5% and double digits. Sounds like little, but that the anchoring of inflation expectation is going to cause long-term interest rate to rise very sharply.
And even earlier this year, Roubini was saying the economy is so strong. It got through last year when I said the economy is going to fall apart. It got through last year, so it must be no landing on top of all of this inflation. And the reason why he came up with this ATI was to try to explain why the economy seemed to be experiencing sticky consumer prices. At the same time, it wasn't, at least according to his view, falling off or getting slower or anything of the sort. In March of 2024, Roubini said, there actually is a serious possibility of what people refer to as a no landing. That growth remains above potential, inflation remains sticky. He said this on Bloomberg television. Paradoxically, the good news on growth may be bad news for the market, talking about the stock market, if that implies the Fed is not going to cut as much and as soon as people now expect. But now here we are in the summer of 2024. The economy now appears to be, at least more clearly and more widely accepted, far weaker than had been previously considered. Again, bond rates are being vindicated as a reflection of those economic fundamentals. They're not being manipulated by the government or the Federal Reserve. They're telling you what's happening. The problem is people don't like the message they often send. Safety and liquidity doesn't comport with high inflation forever. Just like safety and liquidity and continuous demand in the 2010s did not agree with the idea that QE was successful. In fact, it told you the QE wasn't successful. But economists always get interest rates backwards, and that's where a lot of this begins. The truth of the matter is that interest rates are what they appear to be. As Newt Wixell said more than a century ago and has been proven time and time again throughout history, including what we're going through now, low rates are low growth and inflation expectations. Even if you can't see that low growth and inflation in the current macroeconomic data, just give it a little bit of time and it'll get there. In fact, the weakness that we're seeing now in 2024 actually did begin to develop last year. While everybody's talking about sticky CPIs, should have been following the market. The market told you that things were changing. The bond rally began in October of last year, not just in treasuries, but also in European markets, in Canadian markets, even in Japanese markets. There was a rally there. Global growth was shifting last year in October. And it shifted again earlier this year, March and April, heading into May, June in the summertime. You saw the same thing in the marketplace then as well. So the fact that the markets have been saying, don't worry about inflation, you need to worry about economic weakness, and Nouriel Roubini and a bunch of others have been saying, we need to worry about inflation and only inflation, the two are in conflict. And to try to explain and reconcile why the market doesn't agree with Roubini, he says it's manipulated by the Treasury Department because the Treasury is selling more bills than this complete random number he picked out of the air of 18%. It's all just economists looking at everything backwards. They say that interest rates are always a tool for manipulation by either the Fed or now the government, when interest rates are the opposite. They are a reflection of economic fundamentals, regardless of any type of manipulative activity or intention to manipulate activity. The Fed does QE, and throughout the 2010s, the market said it's not working. The Fed does QT, and the market over the last couple of years says we don't really care. It's all about safety and liquidity. As I said in the introduction, if you get safety right, if you get liquidity right, not fake QEs, then interest rates will reflect a very different set of circumstances. Until then, you need to consider what interest rates are telling you rather than trying to figure out who it is that must be manipulating because you don't like what they say. Just like it's not just Treasury yields that are going lower, it's also not just the Federal Reserve that is now abruptly pivoting and changing its tune. There's other central banks doing the same thing. We talked about that, the link below. As always, thank you very much for joining me. Huge thank you, Eurodollar University members and subscribers. Until next time, take care.